Okay, in this video, we're going to talk about lesson 4.7, which is the loanable funds market. And the loanable funds market is going to be the supply and the demand for loanable funds. And where these funds come from will be from people that are interested in saving their money. And the demand for these loanable funds will come from people or businesses that are looking to borrow money in order to make large purchases or businesses looking for investment spending. So because I'm talking about investment spending and loans, and I'm talking about people saving their money, I'm really talking about money as a store of value, M2, and I'm talking about loans. And when we're discussing these things, we do need to think about the future. And when we're thinking about the future and the value of our money, either in savings accounts or in banks or as loans, we need to consider inflation. And so because of that, what I'm going to be doing is I'm going to be thinking about borrowers and savers and the real interest rate. So this is going to be really important. So my y-axis here will be the real interest rate. So I'm just going to get started here with real interest rate. And if you don't need to write this all out, you can just do a lowercase r as a symbol for real interest rate. And the money or the amount that I'll be talking about will just be the quantity. So I just do Q and then LF just so I know I'm talking about loanable funds. So I'm going to be discussing supply and demand with real interest rate as the price or the dollar amount or the amount of money. And then I'll be talking about quantity as in the quantity of money being saved and the quantity of money that's being borrowed. In this market, though, I like to think of this as a bank. And what a bank can do is a bank can connect through its vault. It can connect all the people that are looking to save money with all the people that are looking to borrow money. And so the people who are looking to save their money are putting their money into the bank. They're also the ones putting their money into this market. So the savers are the ones who are giving the supply or offering up their money for supply. So I'm just going to write savers. They're going to be the ones that have the supply here. So savers are going to be for supply, and the people borrowing are going to be the ones that provide us the demand. So the borrowers are going to be the ones that demand these loanable funds. So through the bank, they can take people's savings and they can lend it out to people who need to borrow money. Just like what happens in this market, we're going to be connecting the savers with the borrowers, the supply with the demand. So what I'm going to do, and let me go back for 1 second. This market is going to show the supply and the demand of M2, which includes M1. So I am considering M1 here in addition to M2, but I'm mainly looking at M2 because this is a store of value, and people looking to save their money for the future are looking to have their money hold value. The first line I'm going to draw will be the demand curve. And the demand curve is going to be just like any other demand curve that we've learned so far this year. I use DLF for the demand for loanable funds. It's going to be downward sloping to the right. And that's going to show this inverse relationship between interest rates and the quantity. So if we have really high interest rates, there's not going to be that much money demanded. These loanable funds will not be in high demand because it's expensive to borrow this money. If interest rates are really low, it'll be cheaper to borrow this money, and so more will be demanded. This is very similar to the demand for investment. Interest rates are really high, there will not be much investment. Interest rates are much lower, like they are today, there will be much more investment. These are the three things that will make up the demand curve and that will shift the demand curve in a certain way. So the household borrowing will be consumers like us. They will be borrowing money for cars, for example, or any larger purchases, renovating your house, paying for college. Businesses borrowing, which makes up most of this, will be buying capital, building new factories, new technology, research and development. All of that requiring loans to grow their business. The final one is one we haven't talked about much, and we will talk about more in the future, is the government borrowing. And this will be borrowing in order to pay for fiscal policy objectives, and they will do this by issuing and selling off brand new bonds. So those are the three things that will lead to demand. And this, all told, will be our national investment. Household, business, and government borrowing will be our national investment. And any changes here will shift the curve. And I'll just go scroll down here to write out the two main things that will shift the demand curve. The first one deals with businesses and investment spending. This will be any change or changes in perceived, because we're looking towards the future here, perceived business opportunities. So if business confidence is high, if they are expecting profits in the future, this will lead to an increase in the demand curve. So if this is going up, the demand for loanable funds will go up. The other one will be any changes in government borrowing. And this will be a big focus of the crowding out effect, where the government borrows money, which will increase the demand for loanable funds. So any changes there will lead to shifts in the demand curve. An increase will be a shift to the right. A decrease, as usual, will be a shift to the left. And I'm going to take a second here to draw in the supply of loanable funds. And this is going to be a normal supply curve, upward sloping to the right. I'll go up here. And I'll write SLF for the supply of loanable funds. And this will then give me my equilibrium. I'll do this part and I'll do this in black. So this will be my equilibrium quantity of loanable funds. I just do QLF, or you can do QLF1 or 2 when things shift. And this will be my equilibrium real interest rate. So what this says is at this real interest rate, which is nominal minus inflation, that will be, at this real interest rate, the quantity of loanable funds that's demanded will be the same as the quantity of loanable funds that's being supplied. So all the money going into the bank would be then lent out. All the money would be demanded and then lent out. These are the things down below that will make up the supply of loanable funds. And you'll notice here, this is very similar to C, I, G, and X. Just like with borrowing, consumption, investment, and government, we have consumption, investment, government, and foreigners and net exports. It's the same thing here. Household savings, you and I, business savings, any profits from businesses that go into the bank, government savings if there's a surplus, and foreigner savings, and that's when people abroad will save their money in the United States. But the first three, the ones that are domestic, household, business, and government, that will make up our national savings. And I do want to make a note of this. M2 and this supply here equals M1. And so what's going to be important here is if the supply of M1 would go up, the supply of M2 and loanable funds will go up. And we'll get to that in 1 second. The last two things in this video will be the shifts of the supply curve. And what I want to do here is have any changes in private savings, meaning like private sector, businesses and households, any changes in private savings. So if we are all saving more money, which we have been over the last 2 years as a nation, that will lead to an increase in the supply of loanable funds. The last one is any changes in what's called capital inflows, which will be a key term in Unit 6, capital inflows. And I'll briefly describe this now. This will be any saving from foreigners. Foreigners' savings. So anyone living in a different country that's saving their money in the United States. So all told, this will be any shifts in the supply curve. And you've seen up above any shifts in the demand curve looking towards future profits or the government deciding it would like to borrow money. The last thing I want to say is something that I was talking about 1 second ago with M1. If we have an increase in the supply of money, so for example, I'll put this over here. If we have an increase in the supply of money because of monetary policy, let's say this, if supply of money goes up, that is M1. And if there's more M1 in the economy, people might save some of that money. So the supply of loanable funds will go up as well. Those will shift together. If there's contractionary policy, the supply of money falls, that will lead to the supply of loanable funds falling as well. Remember, M2 includes M1. So if money goes up, loanable funds will go up. If the supply of money goes down, the supply of loanable funds will go down. The last thing, really quickly, will help us with some assignments and some work that you have coming up. I just want to review the Fisher equation, which states that real interest rates, this is a little bit of review from earlier on in this unit, real interest rates will equal the nominal interest rate minus inflation or minus expected inflation if we're looking towards the future. And so we'll be asked to make the connection between a change in the nominal interest rate and a change in the real interest rate. And I want to just make this clear. If, and this is a big if, but if inflation is constant, and this is what you can say, if inflation is constant, if the nominal goes up, real goes up. If nominal increases by 3%, real will increase by 3%. I'll make little bullet points here. And vice versa. If nominal goes down by 2%, real will go down by 2%. So if interest rates are falling throughout the economy, banks are extending loans for lower interest rates. If the interest rate in your savings account has gone down, if nominal interest rates like those are falling, the real interest rates will be falling as well. So that's how you can make a connection between interest rates in the money market and interest rates in the loanable funds market.